Hi, my name's Steve Beck. I'm a chartered financial analyst, a hedge fund manager, and we're going to discuss the competitive strategies and industry strategies associated with asset values. Let's look at the competitive advantages available to companies. The first thing we have here is innovations. Companies can innovate new products, high-tech companies, etc. That can give you a competitive advantage. Of course, the culture of the operation, if it's cohesive, that can also provide you with some form of a competitive advantage. Cisco supposedly has a wonderful culture, and we all know or heard rumors of the cultures associated with our favorite Larry Ellison and Oracle. Then, of course, we move to implementation. In implementation, how well we implement our strategies. We'll move on to strategies in a second, but if you are very good at implementing your strategies, that can provide you with some form of competitive advantage. And finally, the systems. Systems, of course, when we're looking at systems, we're looking at distribution channels. We're looking at things that provide us with cost leadership and differentiate our product. All of these four will hopefully provide us with some kind of a cost leadership, and if not, then we're going to have product differentiation because of these four competitive advantages. Moving over to strategies. The company, once they've developed their competitive advantage, really needs to implement some form of a competitive strategy. So what we're going to do is firstly search for some kind of a favorable competitive position within the industry. And then from that, hopefully we get some kind of sustainable advantage which will then allow us to charge higher rates of return than the normal in the industry. What we're going to try to do is this sustainability really is the key here to trying to determine what your return on equity is going to be. So let's have a look at this, because the choice of strategy and your competitive advantage is really what's going to determine how successful your company is in giving the shareholders some return on equity in excess of what the norm in the industry is. The thing to remember is when a company tries to make a decision on which strategy to follow, it's going to be dependent on the industry. Now, some firms are able to choose a strategy that ultimately changes the entire industry through innovation or something of that nature. This doesn't happen too often, but if you or the company is able to achieve that, then of course that strategy and that competitive advantage will result in a lot higher return on equity and therefore very attractive stock valuations. The second thing to remember in the industry is what is the relative competition within that industry? Is it highly fragmented? Are there a lot of competitors around? Or is it some kind of oligopoly like your Coca-Cola, Pepsi type oligopoly, or a cartel, for example, like OPEC? So what we're looking at is the size of the industry, the competitive nature of the industry, and the company's ability to maybe change the nature of the industry over the long time or the long period. So what we're going to do next is look at some of the competitive forces that really drive the industry and drive the company's decision in selecting a competitive strategy. The first one is barriers to entry. The higher the barriers to entry, of course, the better for the companies that are already involved in that industry. Substitutes, always a problem. There could be some form of a substitute coming out. Generic drugs are a classic example of this. Any threat of substitutes will reduce the likelihood that you'll be able to achieve superior return on equity going forward. Bargaining power of buyers and suppliers. There's two sides of this equation, of course. You've got your buyers. Few buyers are able to really take control of this industry regardless of what you can do. They can squeeze your margins, etc. And then also on the other side, on the supplier side, few suppliers. OPEC is a classic example once again, where the suppliers have all got together and they can squeeze the price up, forcing the buyers to pay higher prices for their products. And then finally, as we mentioned before, the competitive nature of the industry, highly competitive, fragmented oligopoly. These competitive forces are going to determine how you can implement your strategies and what your return on investment is going to be within that industry. So the competitive forces, though, this is a really dynamic type of situation. The large companies, of course, have a major input on the competitive forces. If the industry is made up of one serious player, in the semiconductors, for example, Intel, they really have a solid grip on that industry. sure, they can change some kind of their strategies, and that will definitely affect AMD and the rest of the chips. So what we've got there is that Intel has a major impact on the competitive strategy or nature of that industry. Furthermore, the industry changes over time. In the chip industry, while we're staying on that example, I mean, we think back 5-10 years, chips were in a very few places, more than likely just in your PC and maybe in a few other spots in your house. Nowadays, of course, they're in everything. They're in cars. They're in, your cell phones. Everywhere you see, there's just chips everywhere. So the nature of the industry is changing as the technology evolves. Well, this dynamic situation will ultimately change the competitive nature of your industry and therefore change the industry immeasurably or measurably, hopefully, going forward. One thing to remember is that in many cases, firms try to protect the structure of that industry rather than actually try and get product differentiation. And let's take a look at that. I mean, if we're thinking of Coca-Cola, Pepsi, those types of companies where they have an oligopoly, they have a fairly high return on equity, they would rather keep that oligopoly in place or the competitive nature of that industry in place and protect the structure of that industry by, let's say, cutting costs or rather than trying to differentiate their products. And the reason for this is the nature of the industry is known to them. Our return on equity is high or relatively high. New entrants would start undercutting that, would threaten them. So rather than concentrate on product differentiation, they try to keep the structure of that industry in place. And while we're on the competitive nature of the Coca-Cola or the bottling industry, should we call it, what we also got to understand is there's really limited amount of innovation that can occur. I mean, how can you really change a Coke or a Pepsi product too much? In the high-tech industry, of course, you've certainly got differences there. And innovation can, turn the industry upside down, turn it on its head, and the next thing, the barriers to entry are removed, and there's just tons of new entrants and threats of substitutes coming in all over the place. So we've really got to look at the nature of the industry, look at the barriers to entry. It all basically fits together, and as I mentioned before, it's a very dynamic process. So let's have a look at some of the generic competitive strategies that companies try to implement to try to gain some form of competitive advantage. The first one, as we mentioned earlier, was cost leadership. Cost leadership, really, you're looking at your Southwest Airlines, the low-cost leaders. They come out, they provide a good service at a relatively cheap price. The thing to remember in cost leadership, of course, is that the service needs to be comparable to other airlines. You can be the low-cost airline, but if your service is terrible, your planes always arrive late and they're constantly breaking down with delays, the cost leadership doesn't really help. So your product needs to be similar to other products, and you need to have some kind of a cost leadership here. The second strategy that you could maybe target is differentiation. Of course, you go out, try and get a product that's slightly different to everybody else's. Maybe it's superior, innovative, something of that nature. If you can differentiate your products from other products, then maybe you can get some kind of competitive advantage that you can sustain into the future. And the third area is really focus. Focus here, we've got two different focuses, and it's back to the top again. Of course, you've got your cost focus and your differentiation focus. But what we're saying here in the focus is you try to target one specific area of the market that you decide is really not being serviced properly by the rest of the marketplace, and you focus on that particular niche, and then you try to become either the low-cost leader or product differentiation to attract clients. Now, by implementing or attempting to implement each one of these or one of these is really the idea behind this is to get some kind of sustainable advantage, competitive advantage going forward so that you can increase your earnings. There's a couple of other points we need to mention as far as competitive strategy is concerned.